You ever wonder how some billionaires seem to pay less in taxes than a middle-class teacher? It's not magic. It's a maze of offshore tricks, shell companies, and friendly tax havens. And sitting pretty near the top of that list, the Cayman Islands. Now, today we're peeling back the tropical curtain on one of the most powerful tools the rich use to slash their U.S. tax bills, legally or at least questionably so. Picture this. You're a hedge fund manager in Manhattan pulling in millions a year. If you took all that money as income, Uncle Sam would take a nice chunk, maybe 37% at the federal level alone. But what if instead your fund is legally based somewhere else, somewhere sunny, somewhere friendly, somewhere like the Cayman Islands? The Cayman Islands are a British overseas territory with no corporate income tax, no capital gains tax, and no wealth tax. That makes it one of the most attractive places in the world for individuals and corporations who want to legally avoid taxes. And let's be clear, we're talking about tax avoidance, not tax evasion. Tax evasion is illegal. Tax avoidance is when you hire a team of lawyers and accountants to exploit every loophole the law allows, and the Caymans are the perfect playground for that. So how does this all work? It starts with a shell company. Wealthy individuals or corporations set up what's called an international business company, an IBC in the Caymans. This shell company doesn't manufacture anything. It doesn't sell anything. It may not even have employees. But on paper, it's the beating heart of a multi-million or billion-dollar operation. Now, here's where it gets clever. Suppose you have a US-based company that licenses intellectual property. Maybe you own a tech startup. You transfer ownership of your patents, trademarks, or software to the Cayman company. Then your US company pays the Cayman company for the rights to use that IP, creating a huge expense that reduces your US taxable income. The money that would have been taxed in the US now flows to a tax-free jurisdiction. It's a maneuver known as profit shifting, but that's just one play in the offshore tax playbook. Let's talk about hedge funds and private equity. You've probably heard of carried interest, the infamous loophole that lets investment managers treat income as capital gains and pay a lower tax rate. But here's what's less talked about. Many of these funds are actually incorporated in the Cayman Islands. Why? Because it allows them to attract foreign investors without triggering U.S. tax laws. And for the U.S. investors, it means they get paid through a foreign entity that delays tax obligations or allows income to be structured in a more favorable way. Another common tactic is called inversion. That's when a U.S. company merges with or is acquired by a foreign company, often based in a tax haven like the Caymans, and then reincorporates abroad. On paper, the company is now foreign. In practice, it's still run out of the U.S., but with a much lower tax bill. You might be wondering, how is any of this legal? Well, that's the billion-dollar question, and the answer is the tax code allows it, or rather, it doesn't explicitly prohibit it, and the wealthy can afford teams of experts to ensure they dance right up to the legal line without stepping over. U.S. law does try to limit abuse. There are controlled foreign corporation (CFC) rules that say U.S. shareholders of foreign companies have to pay tax on certain types of income, even if the money stays offshore. There's also the Foreign Account Tax Compliance Act, FATCA, which forces foreign banks to report U.S. account holders. But enforcement is inconsistent, and the game is always evolving. Let's not forget trusts. Wealthy individuals often create offshore trusts in the Caymans to shield assets from taxes and even lawsuits. These trusts can be structured to benefit family members across generations while avoiding estate and gift taxes. Now, here's the kicker. Many of these same people who use offshore structures to avoid paying U.S. taxes are also benefiting from U.S. infrastructure, security, markets, and government support. It's a system that rewards global mobility while leaving regular folks holding the tax bag. To be fair, not every offshore structure is nefarious. Global companies with legitimate overseas operations often use tax havens as part of broader strategies. But when companies like Apple or Google stash hundreds of billions offshore, it raises eyebrows. In fact, at one point, Apple had more than $250 billion parked overseas. Why? Because repatriating it to the U.S. would trigger massive taxes. It wasn't until a tax holiday under the 2017 Tax Cuts and Jobs Act that many companies finally brought some of that money home at a discounted tax rate. And let's not forget the Panama Papers and Paradise Papers, massive leaks that expose just how widespread these tactics really are. Politicians, celebrities, CEOs, and criminals alike were all in on the game, using the Cayman Islands and other havens to hide money, minimize taxes, and obscure ownership. So what's being done about it? Every few years, Congress talks about closing the loopholes. Some legislators want to tighten inversion rules or eliminate the carried interest loophole. Others push for a global minimum tax to reduce the incentive to shift profits overseas. But lobbyists are powerful. Campaign contributions speak volumes, and most reform efforts either stall or get watered down to the point of ineffectiveness. Meanwhile, the IRS is underfunded and overwhelmed. Chasing down sophisticated international tax schemes is expensive and time-consuming. And while the IRS does pursue big fish occasionally, the truth is they often audit low and middle-income filers at higher rates simply because it's easier. For the average person, this feels like a rigged game. You play by the rules, you pay your taxes, you fund the schools, roads, and social services. Meanwhile, the ultra-rich hide their fortunes in palm-lined bank accounts, sipping rum punch on a yacht named Tax Shelter. There's a moral and economic cost here. When the wealthy dodge taxes, the government either cuts services or shifts the burden to everyone else. That undermines public trust. It deepens inequality, and it breeds resentment. But here's the uncomfortable truth. Much of this isn't illegal. It's the result of a system designed, intentionally or otherwise, to favor those with access to elite legal and financial strategies. That's why the conversation needs to shift from just blaming the individual to demanding systemic reform. Until then, the Caymans will remain open for business. The shell companies will keep multiplying, and the rich will keep finding new ways to make sure the IRS never gets their full cut. If this kind of legal and political analysis helps you understand the system better, or makes you just a little angrier at how it works, then hit that like button, subscribe to Due Process Daily, and share this video with someone who still thinks the tax code is fair. Because justice isn't just what happens in court. Sometimes it's what gets hidden in plain sight on a white sand beach just beyond the reach of U.S. law.